two types of inflation. There's the supply demand inflation, when demand is strong enough and it presses up against capacity, like you don't have enough labor, unemployment rates are low, and capacity is low, and then prices go up, and there's that kind of inflation. And then there's a monetary inflation, which comes from the supply of debt being too much so that they produce more of the money, and the holders of those financial assets, particularly bonds, because bonds is just a promise to receive money that the central bank can print, the holders of that then go into those other things. And then what happens is then you just have to follow the money. So you see who gets the money. And then when they get the money, you see what they do with that money. So let's say if you change who gets the money now, because we're going to change that, taxes will change that, other things will change that. That goes then to those other people. So the inflation, the big inflations, the ones that are really most important are not the ones of the supply and the demand. They are the ones like that which followed 1971, my example. Okay, there's not enough money. You put it down, you devalue, in other words, you sever the link. And then with that, then there's a monetary inflation. You go into those other things, and then you have that. So the risk, let's say there's two risks. We will have a hell of a lot of demand because we put all that money in. Cash is all over the place. And even investments, all the investments go up because of so much cash. And how do you find a good investment? But there's so much money, and it'll change the amount that is in the hands of individuals and so on. And so now it's in cash, and that'll move on because cash is trash. I mean, I'd say that because it'll have that negative real return. So we're going to the real risk. You'll experience more inflation. Right now, a lot of it is in cash, and there'll be a lot more money being produced. But you'll experience that more in that kind of inflation. Things will go up. You could see inflation in houses, inflation in many things is going up, and then you'll start to see probably some labor inflation. If you start to see labor inflation and so on, it'll be a different kind of inflation, though. It'll be because we're in a more digital society, there won't be, those things can be produced. That supply of digitalization can be produced without the capacity constraint. But the big monetary inflation is the thing. Where do I store my wealth? Okay? Because what happens to the markets is then when you go to those other things, let's say you go to stocks, you go to real estate, you go to other things because they're getting out of that. As those prices rise, like a bond, their future expected returns go down. And as they come closer to the interest rate, so now you've got whatever the interest rates are, it depends on the country, but it comes down, then there's no longer the incentive to buy those things, and you could have trouble. And it becomes very difficult to tighten monetary policy because the whole thing falls apart. Everything's interest rate sensitive. And so the central bank has got to then print that. Then you have negative real returns in stocks and other assets, like we did in the 70s, but the nominal return goes up. That pattern has happened over and over.
And in this year, we've seen institutions like yours. I mean, I don't know whether you guys have actually bought any Bitcoin, but I certainly know that you're interested in it. We've certainly.
I have some Bitcoin. I think Bitcoin's greatest risk is its success. Because as it becomes more, right now, it's not such a big deal. And, fighting it is more of a big deal. And that's it, because it's not that big a deal. As it becomes a bigger deal and more of a threat, let's say people want to sell their bonds and they want to buy Bitcoin. and they want to do that in a bigger way, like buying gold or something in a bigger way. And then there's more transaction. They lose control over that, and that's an existential risk. There's a real economy, and there's a financial economy, and we shouldn't confuse those things. In other words, people think, okay, the price of the stock, the price of the house, the prices go up, and they think they're richer, and that's not true. It's the same house. They just do the accounting for it, and then, oh, they say I'm richer. They're not richer. They have the same house. And so I want to separate the financial that we're talking about with productivity, which is the real thing. And I agree with you that they don't know how to, you can't actually calculate it efficiently because you're trying to measure one thing against another using a common denominator. And so let's say, for example, if you would if pictures were GDP, if all GDP were pictures, and then you would say, what's the value of pictures? And you would say it plunged to zero. But yet there are more pictures. You could take them on your phone, and you could take them all around. And there's not a good translation mechanism for saying, okay, actually we got all of this other stuff around, and it's so, because you have not a common denominator when you try to put that in value, if you change value. So it can't be productivity can't be well measured, but at the same time, we know that we're changing intellectually and so on. We are accelerating. That the human, it used to be the muscles, and then it sort of goes higher and higher, and it's now, that's the prefrontal cortex. And can you now invent and do things, because the doing of anything else, it becomes increasingly not worth anything because it could be replaced by robotics and other types of things, and that creates efficiencies and so on, but it also creates tremendous social consequences in terms of things like incomes and wealth disparities and so on, that we haven't begun to approach, like how does one deal with that? So there are going to be revolutions, revolutionary changes ahead in terms of all of those issues. In other words, okay, how do you deal with the wealth? What does it mean? Do you have to be productive? What do you do with those people? Is it cost effective? And then you think about even things like how it's going to have an impact on longevity. I mean, like if you take average lifespan and so on, you see an upward curve, and then you see the reasons for that upward curve in many, many ways, wearables and all sorts of things. So the world is going to change in an incredibly fast pace. And then related to that technological change, whoever wins the technology race wins it all economically and militarily.